Welcome to the deep dive. Today we're digging into the economy's next chapter.
Yeah, we're looking at a recent YouTube video from ARK Invest focusing on their market outlook.
Exactly. And our mission for you is pretty simple. Cut through the jargon, make sense of the complex stuff, and really pull out the key insights on where the economy is and, where it might be going.
We'll hit some surprising points, things that might seem a bit counterintuitive at first.
Right. We want you to walk away feeling genuinely well-informed. Okay, let's unpack this.
Let's do it.
So to kick things off, the source, this ARK video, talks quite a bit about a rolling recession. We hear that term thrown around, but what exactly are they saying it means in this context?
Well, what's really interesting is their take that this isn't, something new. They're arguing it's actually been happening for the last 3 years.
3 years?
Yeah. But the good news, they think, is that we're finally getting near the end of it.
Okay, so what is it then? A rolling recession.
It's basically where different parts of the economy take a hit at different times. It's not like 2008 where everything fell off a cliff together.
Oh, okay. So, like, manufacturing might dip, then maybe tech, then services.
Yeah,
It sort of rolls through.
exactly, sector by sector. And they point to specific signs of this softening. The consumer, for one, and definitely the housing market.
Right, housing's been in the news.
Yeah, it's been very weak for quite a while now. And the source notes that prices are finally starting to tick down a bit. That's a key adjustment.
Makes sense, like different parts of an engine sputtering, not the whole thing dying. Okay, so if we're near the end of this rolling recession, what comes next? What's the transition look like according to ARK?
They're projecting a shift from this rolling recession to what they're calling a rolling recovery.
A rolling recovery, okay.
And they expect that to really start picking up steam towards the end of this year and heading into next year. Not just a weak bounce, but gaining real momentum.
And they mentioned a kind of big surprise factor driving this recovery. What is that?
That's right. The key driver, they believe, the thing that's really going to benefit real GDP growth is productivity.
Productivity.
And here's where it gets interesting. This ties into their forecast for inflation. They think it's going to be much lower than expected.
Whoa, hold on. That feels wrong somehow. Usually you hear high growth equals high inflation, right? That's the standard thinking.
It absolutely is the standard thinking, and that's a really important point you raise. But the source directly challenges that assumption.
How so?
They argue that historically, higher growth often comes with higher productivity, and productivity itself is a powerful anti-inflationary force. Think about it, making more stuff with the same or fewer resources pushes costs down.
Okay, I see the logic.
But they say it's even more true now because of, and this is their phrase, deflationary undercurrents associated with the explosion in new technologies, especially AI.
AI again.
Yes. They call AI extremely deflationary. They talk about good deflation, where costs and prices fall so much that demand just explodes. Like, think early cars or computers. Once they got cheap enough, everyone needed one.
So technology is fundamentally changing that old growth inflation link.
That's the core argument. It's a different kind of economic environment they're forecasting.
Fascinating. Okay, so if AI is deflationary, what about other factors like government policy, taxes?
That's another key piece. The source really highlights the importance of tax rates not going up at the end of this year. That certainty matters.
Right.
And the new bill apparently includes things like full expensing of capital equipment, maybe some structures too. They calculate this could bring the effective corporate tax rate down to maybe 14 or 15%.
Which is low, globally speaking.
Very low, one of the lowest in the developed world, they say. And the expectation is that this will really encourage foreign direct investment, bring more capital into the country.
Okay, but what about the deficit? Government spending. You hear people like Elon Musk really criticizing that. How does ARK view that whole debate?
They don't dismiss the concern. They state pretty clearly that deficits are terrible, not a good thing.
Right.
But their perspective on the solution is less about just slashing spending right now and more about getting growth going, strong economic growth, driven by innovation.
So the idea is to grow the economy faster than the debt, kind of grow our way out of it.
Essentially, yes. Grow the denominator, the GDP. They also make a point that the deficit as a percentage of GDP has actually ticked down a little bit already.
Oh, really?
Yeah, and they think it could shrink more than people expect if this productivity-driven growth materializes.
Okay, interesting perspective. Let's shift to monetary policy. The Fed's domain, the source talks about M2 money supply accelerating. What's that about? Should we worry about 70s-style inflation from too much money?
Right. M2 is growing faster, around 4.5% year over year based on their numbers.
So it sounds like a lot.
It does, but context is key here. Historically, that's actually still a very low growth rate for M2.
Okay.
And more importantly, they link it to the velocity of money, how fast money changes hands in the economy. That velocity has been slowing down for decades, really since the late 90s. Meaning, even if there's more money, it's not circulating quickly enough to cause that runaway inflation. People aren't spending it fast enough, basically. It dampens the effect.
I see. So M2 growth isn't the whole story. What about other signals, like the yield curve? Isn't that flashing warning signs?
It is, yeah. They look specifically at the 90-day T-bill rate versus the 2-year yield.
Right.
And that's still inverted.
Which usually means?
Which usually suggests monetary policy is tight. Maybe probably erring on the side of too tight, as they put it. They even mentioned Chairman Powell kind of hinting that without the tariff situation, the Fed might already be easing rates.
Ah, tariffs. You mentioned Powell linking them to policy. What impact have the recent tariffs actually had on prices, the ones from April?
This was another surprise in the data they highlighted. Looking at May and June numbers, it seems very little of those tariff increases are making their way into the pricing structure overall.
Really? How can that be?
Well, specific items hit by tariffs might go up, sure, but it seems those are being offset elsewhere. The big indices, CPI, PPI, the PCE deflator, they all came in really low, like 0.1% month over month recently.
Surprises on the low side.
Exactly. Surprises on the low side of expectations. So that fear of tariffs immediately fueling broad inflation hasn't really panned out in the aggregate data so far.
Okay, let's zoom in a bit more. Beyond the big policy stuff, the source really dug into specific data points. What about the latest jobs report? That always gets headlines.
Yeah, and they called it a weak report, even though the main headline number looked okay at first glance.
Why weak?
Well, you have to look under the hood. Non-farm payrolls, the headline, was 147,000, but they point out that about half of that was government jobs.
Okay, so private sector.
Private payrolls were only up 74,000, which isn't very strong. And then there's this thing called the birth-death ratio. It's basically a statistical plug the government uses to estimate jobs from new and closing businesses. It adds a chunk, maybe 80,000 to 100,000 jobs usually.
Right.
If you theoretically remove that plug, ARK suggests employment could have been negative. And that lines up with the ADP report, which tracks private payrolls differently, that came in at negative 33,000. Small and medium businesses shedding jobs.
Wow. Okay, so the headline number hides some weakness. Anything else in that report?
Yeah, a couple of other things. The average work week was down, meaning fewer hours worked overall. And the household survey, which is another way they measure employment, was also pretty weak, around 90,000, just not showing a lot of strength.
And tying back to AI, how is that impacting jobs right now? According to the source, this feels critical.
It really does. And they say AI is certainly hurting entry-level jobs. They pointed to an article about college grads having a tougher time finding work. Their unemployment rate was up near, 6.3 or 6.4%.
Why entry-level specifically?
Because of tools using natural language programming. That's not processing, but programming. Basically AI that lets you tell a computer what to do in plain English without needing complex code.
Ah, so it automates tasks that might have gone to new hires.
Precisely. They even mention an internal hackathon at ARK where they used AI to solve 13 different internal problems or pain points.
Yeah.
It shows how quickly these tools are being adopted to streamline things.
Okay, so for you listening, if you're maybe job hunting or thinking about a career change, what's the practical advice here?
The message from the source is pretty clear. Start focusing on AI. You need to up your game in that particular realm. Follow the people, the companies actually building and using this stuff. Get familiar with it.
Makes sense. Adapt or get left behind, essentially. Okay, so the job market shows some stress, especially entry level. Where else is this rolling recession hitting now?
Well, it seems to be moving into the services sector now. That sector had been holding up better, but we saw retail sales turn negative in May, down almost 1% month over month. Yeah. And personal consumption was also negative in May, so the consumer is definitely starting to feel the pinch and pull back a bit.
Any other sectors showing strain?
They talked about auto sales. The expectation is that they could go much lower than people think.
Why lower? Pent-up demand usually follows a downturn?
Usually, yeah. But the argument here is about alternatives. Think Uber, Lyft, And now even autonomous options starting to pop up. Waymo, Tesla's service in Austin.
Right, robo-taxis.
Exactly. These services mean a much, much higher capacity utilization for each car. One autonomous car could replace many privately owned cars that sit parked most of the time, so you just don't need to buy as many new ones overall.
That's a huge potential shift. Okay, what about business investment, capital spending? That usually drives future growth.
Capital spending has been kind of flatlined, mostly because of higher interest rates holding businesses back.
Well,
Investment in AI and power generation has been a bright spot, a huge stimulant within that flat picture. And now, with maybe more certainty on taxes, especially that corporate tax cut, the expectation is that broader capital spending will start to pick up. Businesses might feel more confident investing again.
that could be a big boost. Okay, let's turn to housing again. We know sales are weak, historically weak even.
Yeah, very, very weak. Lower than the late 70s even, despite way more people now.
But you mentioned something surprising, a twist regarding mortgage qualification.
Oh, yeah, this one's wild. Apparently, the FHFA, that's the agency overseeing Fannie Mae and Freddie Mac, put out guidance to allow cryptocurrency to count towards qualifying for a mortgage.
Seriously, Bitcoin for a down payment.
Well, not quite directly maybe, but if you hold it on a regulated U.S. exchange like Coinbase, it seems they're saying it can be considered as part of your assets.
Wow. Why is that significant?
Because, as the source notes, a lot of young people have been holding on to crypto for the long term. They have significant wealth there, but don't want to sell to buy a house.
So this lets them use that wealth without selling.
Potentially, yeah. It could open up the housing market more than most people think by bringing in a whole group of buyers who were previously sidelined because their assets weren't traditional.
That is an interesting twist. What about inventory and prices on the ground?
Inventory of new one-family houses for sale is way up. It's actually hitting levels like we saw back during the 2008 global financial crisis.
That's a lot of houses sitting there.
It is, and it confirms that prices are starting to fall. New home prices have been slipping for a bit, but now existing home prices, which were kind of stuck, are also starting to come down. The market is definitely adjusting.
Okay, so if housing prices are actually falling now, what does that mean for the inflation numbers like the CPI going forward?
This is a big deal for inflation watchers. Those falling housing prices, especially rents and owner's equivalent rent, they will get into those indices with a big lag. It takes time.
But once they do,
It's likely to be sustained for a long time. ARK sees this as one of the main reasons we'll see some periods of deflation in the CPI. They're forecasting CPI inflation to drop below 2% by the end of this year.
so they're sticking to that transitory inflation idea.
Very much so. They believe the recent spike was temporary and the underlying trend is disinflationary, driven by factors like housing and technology.
Okay, let's broaden out to the markets. How are they reflecting all this? What about the U.S. dollar?
Well, the dollar actually had its worst start of the year since 1973, which sounds dramatic.
It does.
But again, context. Measured against other major currencies, it's still much stronger than it was in the last decade or so, which kind of implies weakness elsewhere, maybe more than just dollar weakness itself.
Anything else signaling economic activity?
They mentioned copper, prices up over $5 a pound. That's seen as a positive signal for demand in sectors like EVs and data centers, which use a lot of copper.
Interesting. What about bond yields? The 10-year Treasury yield is often seen as a benchmark. It seems stubbornly high.
Yeah, the source seemed a bit surprised. It's still over 4%, given their outlook for lower inflation and maybe slower growth near term.
So where do they see it going?
They think once this new cycle around tariffs and the deficit, once those two are behind us, maybe the long-term yield could settle down maybe into the 3 to 4% range.
Which would still be higher than recent history, but lower than now.
Exactly, potentially marking the end of that long 40-year bull market in bonds we've lived through. A new, slightly higher range, perhaps.
And equities, the stock market. How's it holding up amidst all this?
Remarkably well, actually. They noted the S&P 500 made a triple bottom relative to the price of gold, and now it's starting to move up from there.
Climbing a wall of worry.
That's exactly the phrase they used. Climbing a wall of worry. Powering through tariff turmoil, geopolitical risks like the war intensifying in the Middle East.
Is it just a few big stocks driving it, though?
That was a concern, but they feel it's becoming a healthier bull market because it's broadening out. More stocks participating, not just the mega caps, that suggests more underlying strength.
Okay, one last market indicator.
Yeah?
Bitcoin. How does that fit into ARK's picture?
They noted it's been acting more like a risk-off asset recently.
Risk off, like bonds or gold.
Kind of, yeah. It held its ground surprisingly well, even during the bombing of the Iran nuclear facilities, for example. They confirm it's still in the bull market, technically, and has held its uptrend against gold, so showing some resilience.
Okay, so bringing this all together, after digging through all these indicators and forecasts from ARK Invest, what's the final takeaway? What's the overall outlook?
I'd say the conclusion drawn in the source material is definitely optimistic, maybe surprisingly so to some.
Optimistic how?
They believe that this rolling recession we've been talking about is genuinely transitioning, evolving into a rolling recovery. And beyond that, potentially into a productivity-driven boom in economic activity.
The boom.
Yeah, a boom, but, and this is the crucial part, accompanied by much lower than expected inflation. Thanks to that productivity, thanks to AI and technology, it's a pretty unique outlook.
It really is. A productivity boom with low inflation. That would certainly be a different chapter.
Definitely different from the narratives dominating the last couple of years.
Okay, well, that brings this deep dive to a close. Thank you so much for joining us as we try to unpack ARK Invest's latest take on the economic landscape.
My pleasure.
The really big idea, it seems, is how much things like productivity and technology, particularly AI, are shaking things up. They could be reshaping the economy in ways that lead to this unusual combination of growth and disinflation.
It's a powerful potential shift.
Absolutely. So, something for you to think about as you go about your day. What really stands out to you about how AI and innovation might change the game? How might it reshape the job market? Or maybe even your own financial outlook in the years ahead?
No, lots to chew on there.
Definitely. We'll be back soon with another deep dive. Until then, stay curious.